Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be answering one question and one question only. Why stay invested through a bear market? But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The Federal Reserve will likely raise interest rates by 75 basis points today, with more rate hikes projected in the future. We are already in a bear market, so why would investors stay invested through all of this? Why not just go cash and wait it out?
Well, good morning, Allison. And I think that's a great question. It's a question that I literally face every day, and and it's a great question. I certainly see it from the other side of it is as when a client logs in every day and their account is down even more, so they're like, "What's going on?" So they turn on the TV, whether it's Fox, CNN, pick your mainstream media or CNBC, and everything is gloom and doom, right? The world is literally ending financially, and it's either because of politics or because of the Fed or because of inflation or because of marketing, which, it's interesting having parents in their late 80s because of they get emails every day saying, the scare tactics, right? You need to take action now before the government comes, takes your money. It's literally every day. It's endless and it's marketing BS. And so I get the perspective. I understand it, but that's why I wanted to give this presentation specifically today to answer that question, and so I can reference back to others when they have that question in the future. Is why would you stay invested in a bear market? And even at the beginning of 2022, we knew interest rates were going to go up because inflation was a problem, and we talked about inflation's a problem. The Fed, inflation's a disease and rate hikes are the cure. Well, is the cure going to be worse than the disease? Maybe. We still don't know that. So there's a lot of unknowns here. But why stay invested through all of this? Well, you want to think like a long-term investor and not a short-term investor. And what I have shared out to you right now is a real-time market futures of, today is the day the world ends, right? We've been talking about this for 6 weeks since the last time the world ended, is that the Fed is going to raise rates. They're going to do it at least 75 basis points, maybe 100 basis points. I think that would be overdoing it. But that's an opinion. We don't know what they're going to do. Why is the market up today? Yeah. Ask yourself, why is the market up today? Well, as soon as information is announced, it's immediately baked into the market. So today's rate hike was really baked in, 4 weeks ago when Chairman Jerome Powell said we're gonna, there's more pain ahead. That was kind of the forecasting of there's going to be another 75 basis point rate hike. That's it. That baked in then, and then the market's kind of, up and down, a lot more down, I get you. But until the actual event occurs, when the event occurs, as long as this is the event you expect, the market goes higher. That's insane to a lot of people's brains, right? It's like that there's no way the market would be up today when we actually get the bad news. It's like, no, the bad news gets priced in when it's talked about initially. The actual event itself, as long as what you expect is certainty, and then the markets go higher on certainty. So that's a lot of philosophy there. But if you knew what the market was going to do the next day, you would simply go to cash, bet it all on that 1-day move, take the gain, and then retire. Right. But you wouldn't ever do that. That's a theory. You wouldn't ever do that because in reality, you can be wrong. Right. And if you're wrong, you lose everything. You're financially devastated. So you would never do that. So why would you just quit investing or go to the sidelines for cash and hold it for a while when this is kind of a normal event? This is not, we've been through years with rate hikes. It is not a big deal. In the longer term, it's all part of it. So if you work with somebody who says they know what the market's going to do on a daily basis, that's like the most dangerous thing out there. That's why, financial advising and investment management is a practice just as much as a law practice or a medical practice. Is you have experts in there. That the best part about those experts is they are trained and they have an oath, like I do as a fiduciary, to tell you we don't know what's going to happen. so we best position for what we think is going to happen, and then we make adjustments along the way. That is the best you can do. If you find somebody that says they know, then just run the other direction. So the futures are up, but here's what I want to show you, and I will go through these real quick. I was going to call this 9 reasons to stay invested, but I decided just to go with a generic why stay invested. You can see this is from First Trust, which is a name I trust. Get your own information from wherever you want, but these are slides that they put together to talk to investors. So here's 1970 to 2022. Yeah, how have stocks done? Oh, pretty good. Have there been events in there that caused major sell-offs? Yes. I mean, just look at the chart, and even, back up or focus out to where you can't read the words. All of those are world-ending type of events. Turn on the TV. Oh my gosh, the world's over, right? Well, the world was not over. It did not end in actuality. And businesses, which is what stock ownership is owning fractional slices of business and staying invested in bonds too, where you're loaning money to businesses. Yeah, and private equity, all that stuff. So yeah, there you go. That is a long-term look. So if you think that's that's pretty powerful, right? You want to be on that team that shows that the average annual return for the past, 52 years is 10.46%. Pretty darn good. Do we think it's going to change? I don't think it's going to change. If you have some reason to think that businesses are not the way to make money, then, send me an email and tell me what it is. I want to know what the secret is. Okay, staying the course. So here, a lot of words on here, but here are the intra-year declines and calendar year returns. So realize that every year you have significant declines. It is part of everything. We're out on 2022, where, minus 24 was our largest decline there in yellow, and we're currently at minus 20%. Are we going to end the year in the red? Probably. I've personally forecasting a significant bump out of the elections, but do we get all the way back to even before the end of the year? I don't know. That's a stretch, right? Because it's like 20% from here. Could happen. Don't know. But just realize that the blue lines are where the year ends up, and then the yellow is the intra-year sell-off. So every year has a sell-off. It really does. This year is significant, but not as bad as 2002, not as bad as 2008. And 2001 was worse as well. And you back into the 80s, you can kind of see that as well. Okay, so why not invest in something else? Well, here are all your major asset classes. You have stocks, gold, treasury bonds, inflation, home prices, cash, and oil. You can invest in all of those. The inflation's a CPI index. Stocks have won, even though you look at that blue line and you see the nosedive that it's currently in right now. Yeah, well, look how far you are still above everything else out there, right? So that's why you stick with the program, even though you don't like the news that you're hearing on a daily basis. Okay, here's your history of bear markets. Yes, they happen. This is since 1942. You see the bear markets in yellow, if you could even see that, right? And then the bull markets are in blue. The bull beats the bear over time, all the time. So unless you have, if you need money for buying a house or because you have a tax bill coming, then you may need to take some money off the table right now. But other than that, you simply hold through. You execute the bear market strategy. You get rid of the speculative stuff. You go only best of breed. You grit your teeth. You buy more when the market's down, and that's when you get rich. Right? Is when you pick up all these stocks that everybody else are selling at ridiculously low prices. That's the secret. Now you know. All right, next one. We have the positive and negative years since 1926. Again, the average annual return is 10.52%. So average positive return there in blue, 23%. And the 25 years we've had negative returns, negative 13%. Well, guess what? People survive that. Yeah, you can have a negative year. You are going to have a negative year if you stay invested, obviously. So the ratio there of the past almost 100 years, 71 to 25, that's what, 3/4 of the time the market's up. I commonly say 2/3 of the time, just because I think it's a little easier number. Yeah, 2/3 of the time the market goes up, 1/3 of the time it doesn't go up. Stay invested for the long term. You'll be happy you did 10.5% annual. Okay, this is the probability of positive returns. These are not returns. But on a 1 day, it says 50, 1 day, what's the likelihood of the market being up or down? Well, 53% up. 1 month, 63% up. 3 month period, almost 70%. A year, 77% probability. We just looked at that number. Over a 3-year period, 87%. Over a 5-year period, 92%. Over a 10-year period, 97.35%, meaning there have been a couple of cases where you went full 10 years without a positive return. There's called lost decades. Japan had one of those. The U.S. has had one of those. Those happen, but as you can see, they are rare. So that's why you stay invested. All right, a couple more things to look at. Here's your daily volatility. Here's 2022 off to the right. The average is there's 62 days a year of market moves of more than 1%. Yes, the year's not over. I get that. But as far as a volatile year, stock market isn't really that much more volatile yet than other years, right? So, and you look at 2020 where we had COVID. I mean, gosh, we had markets moving 7% in a day. It was kind of crazy. All right, last eye chart for you here is once you have big down days, which is when you want to sell, right? Is after those big down days, right? That's when people are like, I want to go to cash. Well, historically, the returns have been huge. If you simply wait for big down days and you put more money to work, i.e. you buy there, then you get the snapback, right? And we talk about the snapback in technology with all the time. And it's just like that. You don't want to be on the sidelines for the snapback, because the snapback happens even faster than the sell-off, right? When everybody realizes the market's oversold and the money flows back in, you wake up the next day and boom, your favorite stock, which you just sold out of because you wanted to, I guess, time the market, is now up 7% the next day because the world actually did not end on the Fed rate hike. And then, sorry, I said last slide, there's actually one more. So this is a history of market corrections. We're down here at the bottom, 20% or more. They happen about every 5.3 years. They generally last about a year. So that's kind of your history of the S&P bear markets. And we are, when's the last one? In June. That's when we started our bear market. So that's why you stay invested. Again, we'll go back up to the front, the front slide there. I'm sorry, that one. This is why you stay invested. You just don't know. Your move to cash and your move back in would be the equivalent of market timing. And you're trying to market time on a daily or weekly basis. Most people know that is a fool's errand. Maybe you're the one person that can do it. That's weird that it happened to fall upon you, but I'm not saying it's not, but I'm just saying for most people, you just want to stay invested. You execute your bear market strategy where you stay very focused on exactly what you're invested in. And that way you can, over time, you're going to build wealth, right? Can't guarantee it on a daily basis, but certainly over time, that's why you want to stick with your investing strategy.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar. We'll see you back here tomorrow.